Good morning, good afternoon, depending on where you are. Thank you for joining us for today's webinar, where we'll discuss Q1 results and current credit quality trends. My name is Sean O'Brien. I'm president of QuickRate, and as always, am pleased to be joined by David Ruffin from IntelliCredit. David, if you want to go ahead and introduce yourself.
Yes, always a pleasure to join you on a quarterly webinars like this, Sean. Thank you.
Thanks, David. And then also introducing Aaron Chestnut. Aaron's with a strategist with the Infusion with our marketing team. Aaron, you want to go ahead and introduce yourself?
Nice to be here today and talk about all these great insights. Ultimately, I used to be on the client side of things at a bank and a credit union in the chief marketing officer role. But here at Infusion, I help clients with these insights and make them into action.
Thank you very much, Aaron. Kind of the agenda for today is, just kind of talk through the first quarter results. David's going to, as we touched on, is going to talk about, give us a credit update. Aaron's going to talk about what we're seeing in customer trends in terms of the marketing campaigns we run for banks. And then we'll just share any updates from Quick Analytics and IntelliCredit. As always, a couple of reminders. One, we will send out a link to the recording today, along with the copy of the slides. So look for that tomorrow afternoon in an email to you. Secondly, if you have questions throughout the presentation today, certainly utilize the chat feature or the Q&A feature, and we will monitor those and take those at an appropriate pause in the discussion or at the end of the discussion today. And then finally, we do always start with a few polling questions. So we do have a few for you today. Certainly appreciate your consideration and participation in these. So without further ado, we'll get those started. Just a few today. They're pretty simple yes or no's other than this first one. What concerns you most in 2025? So again, kind of a repeat from the first quarter. Cost of deposits, attracting deposits, credit quality, margin compression, lack of loan growth, or others. So we'll give you 30 to 45 seconds to look at these. Okay, we'll go ahead and end that one. Thank you very much. Share those results. So leading the way is attracting deposits. So certainly I think that was consistent from the first quarter. Cost of deposits and lack of loan growth, and then credit quality and margin compression. So again, thank you for participating on that one. Leads to the next one, just estimating deposit growth. What are you estimating for deposit growth this year? Again, just kind of a range, 0.1 to 2.5, 2.5 to 5, 5 to 10, and greater than 10%. Share these. So most everybody's kind of in the 2.5 to 5%, then 0 to 2.5%, 2.5 to 5, kind of the leading the way, and then 5 to 10. So thank you for participating in that question. Let me stop there. And this is kind of a follow-up question to that. Are your deposit growth plans on budget through the first quarter? So just a yes or no here. This is encouraging. 74% of you, you're on budget for deposit growth, which is great. 26% of you are not. All right, and then the next two questions are kind of along the same lines around loan growth estimates. What are you estimating for loan growth this year? There's results. This is good to see, 46% of you between 5 and 10%, 28% of you between 2.5 and 5, and then 18% of you between 0 and 2.5%. So thank you for sharing that. And you can probably guess the next follow-up to that is, are you on budget through Q1 for your loan growth plans? Okay. 63% of you are, 37% of you are not. So again, thank you very much for participating in the polling questions. We'll kind of get moving on. I mean, I think, both pretty encouraging given some of the uncertainty we've had in the first quarter this year. But certainly, I think as in the last 30 days, I think a lot more confidence has kind of returned to the market. A couple of just, a lot of these slides we've kind of covered before. I think I just want to keep them top of mind because I do think it is top of mind with the regulators. Just a reminder on the uninsured deposits, and just a reminder to make sure you are monitoring your coverage and capacity of those uninsured balances, and if necessary, able to demonstrate that you have secured borrowings or contingency funding sources to address those uninsured deposits. In the same way, we felt like we might get a little bit of reprieve here on the underwater securities portfolios. Again, every day we move closer to a lot of these rolling off. We certainly did improve a touch here in the first quarter. It certainly continues to be an overhang for any M&A activity, but again, I think we want to just continue to monitor this because it is a bit of a headwind for still a large number of our banks. I think we asked about loans and deposits at the top. Again, I just think we're in this new normal for deposits. Where's our growth going to come from? I think, finding, identifying, obtaining, attracting new deposits at affordable costs is really, I think, as the polling questions addressed, really are front and center for most of us. And I think, one of the things that Aaron and the team, talk a lot about is just your customers and prospects who have both the capacity and the propensity with their deposit and their relationship with you, trying to attract larger wallet shares, from our existing customers. I think I was encouraged that both or the majority of banks seemed on pace budget-wise for deposits and loans. That's really encouraging. Again, I think deposits will probably remain the top priority, both from just a growth point of view, but also along a pricing point of view. The competition has and will continue to remain fierce. And so I think, again, as part of these quarterly trends, that's why we want to make sure we have a customer focus, a marketing focus, just to talk about what's working, what we're seeing, because I do think it's really front and center for us in obtaining, our strategic growth plans. Let's take a quick peek at the QCBI numbers for the first quarter. Again, the number of banks, continues to just drop, albeit a bit more moderately than we've seen. Again, M&A has been certainly slowed by interest rates and these underwater securities. Encouraging though, asset growth here ticked up in the last 12 months. I think equally, kind of stabilized. Loan growth has stayed. It's still declined a touch, but hopefully we're stabilizing here. 22% of the banks, community banks in the country, still saw no loan growth, which is concerning. But I think half the banks saw loan growth of greater of 5 to 10% or greater than 10%. So again, I think that's an encouraging sign. But you can see here in the bottom, the smaller banks are still 0 to 100, where most of the challenges really lie. Deposit growth, again, I think an encouraging sign. As an industry, we saw it tick up here over the last 12 months. 21% of the banks, again, saw no deposit growth, but nearly, nearly half of the banks between 5 and 10 or greater than 10% deposit growth. So, again, I think that's an encouraging sign. Not surprisingly, the larger banks are having a little bit easier go at attracting deposits. And again, the 0 to 100 saw positive growth, but not what the other banks of a larger size saw. Yield on loans continues to remain strong. I think that's encouraging to see across the board. All banks, particularly the smaller banks, are able to pass along pricing, appropriate loan pricing. Cost of funds ticked down, which is encouraging. The larger banks, are able to carry a larger or a higher cost of funds than the smaller banks. That allows them to be a little bit more flexible in instances, pay up for deposits, which again makes it more challenging for the smaller banks. But we did again see, improvement in cost of funds in almost every asset size this quarter. Margin improved as well. So again, I think, despite some of the uncertainty that felt present in the first quarter, banks have continued to keep their head down and do a good job. And we've seen, margin improvement through the last 12 months. Again, I think we really saw it in the asset sizes of all banks. Last quarter, the 0 to 100 million were actually the highest median net margin, but you can see the 100 to 250 million represent that this quarter. But again, encouraging to see even the smaller banks able to increase, their margin. Non-interest income ticked down a bit, not surprising, given some of the lack of refinancings obviously occurring in the mortgage market. And again, not surprisingly, banks of the largest size with a sizable increase in the ability to generate non-interest income versus the smaller banks. Efficiency ratios ticked down from where they were over the last 12 months. Again, encouraging to see. And then to the right here, you can see, not surprisingly, again, the smallest banks with the greatest challenges to continuing to drive efficiency gains, with the largest banks having the most capabilities in lowering their costs. All this translates into a pre-tax ROA that's improved over the last 12 months, improved really almost across, again, all buckets of asset sizes, and in the same way with core operating earnings, everybody above 1% core operating earnings as a percentage of asset size, which is encouraging, because you need core operating earnings to generate any ROA and ROE. And again, encouraging to see over the last 12 months, we've increased ROA as an industry and ROE as an industry at the median levels. Across the board, not surprisingly, pretty even here among most bank, the buckets 0 to 100, again, struggling the most to generate, higher ROAs and ROEs. But again, a better picture, than we've seen. So it's, again, a good start to the year. This final slide is, something that we, again, at the behest of a state association, began to include in our presentations. You can see not only the median value for each of these metrics, but you can see a spectrum from the 10th percentile all the way up to the 90th percentile. So you can kind of see how, the full spectrum of performance in the industry. Just as a reminder, your state and this national performance, are available to us. You can, certainly reach out to us and request it. I put in the chat, you can request a complimentary state and national performance trends. Thanks to Lori from our team for putting a link out here to go ahead and request that. And you can certainly reach out to anyone here at Quick Analytics, and we will share that with you as well, both at the state and national level. So if you're interested, you can go ahead and click on that link in the chat. Okay, at this point, I am going to turn the presentation over to David, who's going to walk you through the credit piece of our presentation. David, I'll stop sharing and you can take the screen.
thank you so much, and hopefully you can see this
I can.
as a follow-up to the loan growth and deposit growth charts that Sean shared. Of course, corollary to that is where are you on wholesale funding? A reminder here that we focus on banks under $10 billion. That tends to be the primary focus of our marketplace. And therefore, as you can see, we regionalize here using our sister divisions data, Quick Analytics. In terms of wholesale funding, because of the deposit growth of late, we are seeing some tampering or tearing downward in terms of the need of the wholesale funding, particularly after the big shocks of rate increases a couple of years back. The Northeast leads the regions in terms of wholesale funding. The Southwest, apparently Southwest banks under 10 billion less or more liquid, with deposits needing less wholesale funding. A corollary clearly to that, of course, is our loans to deposit ratios. Again, the Northeast leads at 89, almost 90%, the Southwest at 70%. In terms of the credit landscape, I think the so-called term of benign credit performance actually does continue into 2025. There have been tick ups of some concern, but not very significant from the fourth quarter of 24. There's still the term that I've been using probably for 5 years on this webinar, which is uncertainty. There seems to be still some uncertainty. As we all know, the markets reflect that, particularly in the short term as the new administration takes hold. There are some indications of rising credit stress, however, and I have to particularly this quarter focus on agriculture because we're hearing that particularly in the Midwest because of the preponderance of a lot of ag lending in the Midwest. But that does seem to be, that is an industry that is at this particular point. Missouri, president of a bank in Missouri told me yesterday that they had seen more Chapter 12, which is an agricultural bankruptcy filing, in more than probably 12 years. The CRE segment is a term I've used before, obsolescence to some degree due to digitized work that we all perform, is still an area that I think is worth keeping an eye on from a credit risk point of view, largely because of disproportionate CRE exposure, of course, at smaller banks, which I've spoken about many times before. There is growing lender negative sentiment and credit quality, and I have to say this because I spend time a lot at trade groups, that there's a bit of a delta still between what I consider C-suite and the working lenders and credit officers in terms of what they perceive as credit quality deterioration. There does seem to be a little bit of a delta in that regard. We are still seeing increased loan review downgrades over the past several months. Most of them continue to be in the pass to low pass categories, not yet into criticized classified. As Sean alluded to in terms of stymieing some M&A activity, I think we have heard from some investment bankers there's a little bit of concern now as rates may begin to be stabilizing and becoming more normalized, that some of the uncertainty around credit risk could be an impediment in terms of M&A activity. Again, the focus that seems to be the case with the regulatory scrutiny is in the credit process area, not in the necessarily at the transactional level of arguing about criticized classified loans or non-accruals. The numbers clearly, though, do show that even in commercial delinquencies, we're approaching the highest level in 5 years. We had a big spike up, as you know, at the pandemic before the tremendous amount of assistance, government assistance hit the streets, so to speak. But the other part of that is consumer lending loans or consumer purpose loans still lead the commercial purpose loans from a past due standpoint. I've said this several times before, credit is a long game. It's not really tied very much to what Wall Street does on a day-to-day basis, and yet our financial press is in many ways dominated by that. sensitivity. So again, I think those of us that are managing credit and you all are out there managing credit fully understand credit is indeed a long game. One of the things we've looked at traditionally, of course, is what are the inventory of problems and what are we doing about it? There's no question that we continue to show some, in the last couple of years, some increase in NPLs or non-performing loans. In this particular case, the Southwest leads the rest of the country with about 87 bips. Charge-offs have stabilized or declined a bit, but this is not uncommon because it's been traditional in my long career that most charge-offs often occur at smaller financial institutions at year end. So it's kind of stabilized from that point. But as you can see, the combination of NPLs and the rise generally in charge-offs, while not substantial by historic terms, is still matched over to the right by the allowance for credit losses declining. In this particular case, you've got the West at about 150 basis points. You've got the Northeast banks still under 100 bips in terms of their average allowance for credit losses to loans. So there's a good bit of discrepancy regionalized in that regard. As some of you may recall, my favorite way of looking at this is how much of your acknowledged problems are being covered by current reserves. And again, this line continues to decline. And more importantly, I think for perhaps today's audience, it is declining at a more rapid rate for community banks than all banks in total. A lot of that, of course, is due to the non-current loans increasing at a pace greater than provisions. I think this would be a good time to say this. I have no sense that we're going to be in any kind of a bloodbath or the kind of problems we had during the so-called Great Recession. But certainly we do have to keep an eye on, again, these trends because regulators certainly see these. And I do feel like, if we do get into more credit stress, we'll have to keep an eye on where the trajectory of reserves are. And one of the reasons I don't think we're in as much difficulty or likelihood of facing the kind of problems we had 12 years ago or so is we've got a lot more capital in our industry, as we all know. The Texas ratio is again showing a general trajectory, other than in the West, of increasing, and we all know that's just a thumbnail for credit quality. I've said this many times before. The reason that's of major concern to this audience, I think, is largely because of the real estate dependence we have in our portfolios, and I think all would argue that's undoubtedly the least liquid of all problem credits when you have a real estate problem loan. As far as our traditional real estate guidances that we look at, to the right, you'll see the broader 300% guidance, which is the West leads in that. The Midwest is the laggard, so to speak, in terms of exposure. To the left, you have the issue of the construction, which is the subset, 100% guidance subset, construction development loans. Traditionally, this has followed in terms of the heightened percentage of these have pretty well carried along with the Sunbelt states where there is more demographic population growth and potential for more business growth, which would justify construction loan and development. At the bottom of both charts, you see the numbers and regionalized for those banks exceeding those guidances. They have begun to tick down marginally, not significantly, but upwards of, say, maybe a year and a half, 2 years ago, they are each quarter beginning to pare down a little bit of the exposure in real estate that we've talked about. The other concentrations we look at, multifamily, again, you see there, you've got the Northeast and the West leading. You have the Southwest actually states it the least. I am a little concerned about multifamily. I've said this before in terms of some risk. C&I, again, is about pretty much steady down from the peak of the PPP era. And of course, ag, as you would expect, as I alluded to a moment ago, particularly in the Midwest. I think, given the amount of farm and ag lending, even within commercial banking, that seems to be an area of growing concern as we speak today in terms of credit risk. Again, you've seen this chart before, but we just have to keep a focus on the fact that community and regional banks in particular continue to maintain a significantly larger disproportional exposure to real estate, commercial real estate, than the larger institutions. And again, I think as long as this exists and as long as there's concern about all of the changes going on in real estate and so forth, there will be some focus necessary on this. I hasten to again say this is not empirical data. We're not brokers, real estate brokers, but we see this as a kind of a combination or an aggregation between conferences I speak to or we speak at or attend, hearing regulatory panels, hearing, yes, broker panels, but also during getting a lot of information from the significant amount of loan review we do. These are just kind of where we see real estate in the subsets, and I want to hasten that this is undoubtedly the area of focus in terms of, frankly, investor and regulatory scrutiny of real estate. It's not the general 100-300 rule per se. It is really the subsets of the real estate that you're engaging in lending that is the primary focus. So how you are managing those various concentrations, I think, bespeak to whether or not they are in either of these two categories. I would hasten again to say that it's still estimated that a little under $1 trillion of CRE loans within the commercial banking system are scheduled to mature before the end of this year, which inevitably is going to have a drag on debt service coverage. So I think at this point, I will gladly hand it back. And Aaron, look forward to hearing your presentation.
Thanks, David. Great insights there. We'll just switch over to the slide, give Sean a chance to do that real quick.
Yep, bear with me 1 second. Let me get Aaron's slides up here.
Not a problem. But as Sean's doing that, what we'll now cover is the third leg of the stool that Sean laid out, like what's happening with customers in terms of continuing importance in driving and maintaining deposit relationships, and also as he alluded, the propensity and capacity factors that are predictive in driving all types of product solution adoption. So yeah, going to the next slide, a little bit about Enfusion. Enfusion's perspective is informed by the work we do. We do this all over the country in over 27 states, and with hundreds of community-focused financial institutions, like many that will be on this call today. One of the things that we are really honored by is driving those results that we've been able to achieve with our clients, and they're looking to achieve specific growth goals, whether that's deposit growth or margin improvement, remixing a portfolio to drive lower cost of funds, or even very targeted, granular, high quality loan growth or fee income initiatives. We're able to help them with all of that. And what we do is we constantly track at a specific level, but also at a global level, a lot of data points. And so we're up to about 21 billion in balances generated with clients, and that all ties back to those specific tactics and specific tracking that we do, all supported by basically at this point, billions and billions of reference points that we've collected, through our engagement with our clients' databases that help us understand the opportunities that are in front of each institution, and then also help them monetize that opportunity through implementing targeted tactics to help achieve those goals. So if we go to the next slide here, So you're talking a little bit about that reference point. There's really 2 points. The big picture is a normative database that we have. We call it the Infusion Norm, where there's products and relational insights from over 50 million households. And when you think about that number in the U.S., that's a pretty robust sample that we're tying into. And a lot of times, what we'll do over time is that all those data points become somewhat predictive in understanding what will happen across institutions when it comes to the customer behavior. So we leverage a ton of behavioral information all across the balance sheet, and the intersection of the deposit usage and transactor. When I say transactor, think checking account usage and active borrowing. The data represents how consumers make decisions, what's the overlap, and then how do we migrate customers, whether they are a consumer or business, towards a full relationship or more for a full wallet share. So that's the macro picture. Then we equally as important is using our campaign normative database, and that's made up of millions of records where we've executed campaigns and analyzed them. And in some cases, we've worked with the clients to analyze campaigns, even if they may be running them on their own. But what we do is have that be a combination of insights on both the macro and the very specific targeted activities that allow us to provide context to our clients so that they understand not only what's happening within their 4 walls, but how that compares to the peer norms of what their peers are seeing, from product penetration all the way to the tactical parts of near-term recent similar campaigns that other peers are running, and how the client's performance compares against that. And that really turns into potential to really understand the funds on the balance sheet and the fee income, and also on the income statement as well. So if we go to the next slide, just some pieces from our database that we can look at to see what's happening on the customer level for checking. Probably not surprising, we continue to see moderation in the average household checking balance, and that doesn't vary by segment very much. It varies by business model a little bit, but from a macro picture, the rates have stayed relatively elevated, and then even have come down a little bit, but they're still elevated versus where they were from an interest checking payout perspective compared to what they were about 2 years ago. So you see, go back to that one for a sec. So we see that money is moving out of low-cost deposits and into yield-seeking vehicles. And one measure of that is on the right-hand side where you see the screen. We've seen that the return of interest checking, even in the latest 18-month time period, that household penetration of interest checking has gone up as high as 28.2%. And that was in the kind of the most current quarterly period, compared to as low back as like 26% in the mid 2023 time period. But it does undulate a little bit over time, but looking at that from just a trending perspective. And even within checking, people are seeking yield because there is yield to seek. The institutions like yourselves are looking for that low cost deposit, and encouraging that money being landed even within checking accounts, and being willing to pay a little bit for that. But people behave in rational ways, and so checking is still has all the benefits of low cost of funds, deposits, and stickiness and relationship primacy. But it's also fee income as part of the foundation for the customer's transaction based on that relationship. And so it's still checking because it maintains its status as being kind of a foundational element in an overall relationship. If we go on to the next, there's a couple other trends that we're seeing. When we look at CDs, as we've talked about before, people seeking yield, we've been seeing a continued rise in the average household balance. You see that on the left-hand side, where these balances of households that use CDs are in a group where that capacity, they have the capacity to do deposits. And one thing we're fond of saying is, if you have customers that have high deposits with you, they likely have high deposits somewhere else, and so that capacity translates in targeting those high deposit households. We've also seen a continued march upward in terms of the average balances of those CDs, and so that will also continue to march forward when we look at the penetration of these vehicles as well. In the last 2 years, the penetration has increased almost 50%, going from a near-term low of 7.3% all the way up to near 11%, and it still appears to be climbing. So it still does show that there is perpetual demand by consumers to adopt and get CDs as part of their banking portfolio. Now, obviously, that's the highest cost deposits usually that are in the customer balance sheet, and so you do want to be mindful of that demand. We don't want to overpay for that. We want to keep our cost of funds reasonable. But if we don't proactively seek with our current customers to adopt CDs or maintain CDs, we do have a risk of seeing that if we're not in front of those folks at the right time, that we're at risk of losing them to competitors. Because keeping in mind, it's still a very competitive space out there for demand of institutions to keep growing deposits, and so there are a lot of institutions out there that are very hungry in looking at your customer base to attract those funds away from you. So going back to the comment about how do we defend and grow relationships by being proactive, and the other things that might be, meet their needs. The good news is we constantly find in the webinar that even Sean mentioned, that when you apply a holistic approach to data and you're able to sell based on matching up need, that capacity and propensity that was talked about earlier, that we do have the ability that where we don't have to necessarily be as aggressive on rate. And in fact, we see that a lot of times with our clients, where we give them counsel to say, hey, you're performing way above norm. If you cut out maybe 25 basis points off of your rate, you can still be competitive. You'll probably shave a little volume off, but you'll gain in cost of funds and still be there with the opportunity to be in front of meeting your customers' needs and helping them retain them at a moderate cost. So Sean, next slide, we'll get into looking a little bit at money markets. The money market, kind of unsurprisingly, is fairly elevated. Now we are seeing that the average household balance is fairly steady, kind of maintains itself in the kind of lately in the low to somewhat mid 80s, and maybe just at times a little bit lower. But as rates have started to drop, that will probably start to decrease. But that certainty is that certainly people are looking for fueling what is once like a CD rise, but to really kind of consider that liquidity in this ever-changing market's also important to consumers as well. And so we do see that penetration of adoption of money markets continuing to steadily move upwards, as you see on the right-hand side, starting a climb, approaching almost 125 basis points higher in terms of household penetration in the money market product. So people are still looking for yield, and they're looking for, in this case, fairly easy access to their money at an acceptable yield, given the trade-off between having access and still making some money on their money. So be mindful that people that are in this product do fill a relative need with this product on the continuum products that they use to park their money. But we do see that this does meet consumer needs and will also, helps the institution, manage margin. One thing I've also seen is there's a lot of institutions out there that don't want to reprice their book from a money market perspective. They've got pretty standard, tiers of rates. And so I have seen a trend of creating a new category of product. Many of them call it, and some of you might also already have it, is a high yield savings account, and that's a way to garner and attract some deposits without kind of repricing the book by manipulating the rates you're paying in the various tiers. Going on to the next slide, we also talk about household penetration when we look at the average response rate. And so this is kind of booked accounts from a response rate perspective, meaning that we're targeting households for a particular product and then look at the ratio of the household response by opening an account so that we go past the kind of click or the step in the funnel where you're just like kind of looking for a lead. And what we're really trying to do with our programs is tactically drive converted booked accounts. And you see there's a moderation in CD response rates on the left-hand side, but still fairly healthy. And if we were to rewind the clock even further and we'd look back, that 3.2% average response rate in Q1 still is more than what we would have seen in like a pre-2020 time frame. And then with the money market high yield savings, that's been a little bit more steady. So we certainly see that it has risen as rates started to rise, but it's closing into more of that long-term average in the 2+%. So the key takeaway here is the demand to be harvesting when you're being thoughtful and driving the kind of rifle shot to aim with messaging and being able to control what you're doing is very important. So the more you can kind of target into the right audience to capture the right attention based on these different products is definitely a best practice that we follow and believe in based on our methodology. Going into the next slide, we'll talk briefly about what's happening on basically customer behavior when it intersects with loans, because, probably not surprisingly, the average balance of households using loans continues to climb on average, while the average penetration rate tends to be a little bit more moderate. And this is kind of across the board. Again, across business models and sizes of institutions. The big takeaway here is that there is a high quality customer growth to be had, but you have to be very selective and targeted on where you're fishing. And one of the things that we find is really looking at the mix, balance of products and services that your customers have, and then also look at where they stand. Are they high deposit households with you? That typically tends to be a pretty good place to fish for high quality loans that probably have a higher propensity rate of being seen through to ultimate payoff. Next page here, we'll look at credit cards real briefly. This is a bit of a tale of two cities here because we see a dramatically higher demand penetration with credit cards amongst credit unions compared to banks. But some of that reflects on banks tending to be a little bit more outsourced on credit card, but we're seeing pretty steady penetration of the changes of credit cards. But there's a noticeable pop that you see on the left-hand side when we're looking at credit unions as far as what their penetration increases have been as of late. We'll see in future quarters if that tends to hold or if that was just a moment in time blip. And then finally, want to just look at the consumer loan campaign responses. Similar patterns between credit unions and banks here. Banks tend to be a little less responsive from a response rate perspective of these campaigns, but they see twice the average balance. So again, that quality and that capacity of lending lending volume and lending size definitely at play. A little different dynamics between credit unions and banks. But quality loan growth is available and can help really enhance the overall relationship aspects of an overall relationship. What we find is that the more products and services an individual has with their institution, the more likely they are to respond to future offers. And so really focusing on, from not only from a growth perspective, but for a loyalty and stickiness and retention value, it's really important to continue to take those high value relationships and build a moat around not only their deposits, their loans, and their transactor status, so that you're the institution that they think of and they continue to look for solutions from you specifically. So that was a quick tour of what was happening, and both on a macro customer level as well as from a what we're seeing as far as the focus on deposits and campaigns and the response rates that we're seeing. But without further ado, I'll bring this back to you, Sean.
Thank you, Aaron. And just a reminder, again, we will be sending out a copy of these slides and a link to the recording in a email to you tomorrow. If you need it sooner than that, we're certainly happy to send it earlier. I think, from Aaron's presentation, I hope you benefit and see, just how we know the challenges in trying to market to your customers. And I think you can see in the response rate, right? It is an ongoing, never-ending, process. And I think that's one of the things we try to emphasize, right? Is, if we're gonna fight for these deposits, it really is an ongoing attack. And I think that's, I think one of the things that our infusion team helps with is just being able to manage those campaigns and consistently, proactively go after your customers or your opportunities to grow your deposits. Some final thoughts. Again, I think it's been a real nice start to the year. We did see, as an industry, loans and deposits growing, margins and profitability improving. So, again, I think, as David indicated, let's remain vigilant in managing our credits. And as Aaron talked about, let's continue to fight for those deposits, because obviously they're everything to attaining our strategic growth plans. If you are interested in trying to accelerate your growth, what we do provide is an opportunity assessment. It is an opportunity to learn more about your data and compare that to peers. And again, can be very instrumental in trying to identify where you can go to grow your deposits and loans. Certainly you can reach out to Aaron or Trevor. Their emails are attached. We'd certainly welcome the opportunity to provide you with that opportunity assessment. Just a reminder for IntelliCredit, as David indicated, we do provide third-party loan reviews, but we also do have an application that we would love to demonstrate for you. I think one of the huge advantages is there's no installation required. We can get you up and running very quickly. So certainly encourage you to reach out to us on that. We are offering a 3-month free trial on our portfolio analyzer. We want to show you, you don't have to spend a whole lot of time getting it up and running, but we do want to make sure and show you the value that we believe it will provide before you have to share a penny with us. So certainly reach out to info.intellicredit.com. You can, again, request a demo of it in advance of that. But again, we're willing to help and get you started to make sure you see the value in the analyzer tool. We do have upcoming events that we hope you register for, and encourage you to do so. As you know, if you register, you will always receive a copy of the slide deck and a link to the recording. So on June 6th, we're having a coffee talk where we talk about having bankers join us to discuss loan review best practices. And then on June 17th, we are having a webinar discussing lowering costs and doubling your results for new household acquisition. That will be hosted by our infusion team members. So again, a couple of webinars in June that we would love to see you attend. All of our presentations can be found on our YouTube channel, so certainly take a look. If there's something you've missed in the past, you can go back and see all of our webinars and coffee talks that we've done over the last couple of years. David and Aaron, any final words before we let everybody have the rest of their day?
Well, I just wanted
David.
to say I look forward to being with as many as possible on June 6th, because we've got three great experts in loan review. I think most people understand that's one of the important things about being, as you said, being vigilant about credit. And we're very prideful on the way we use technology, but also extremely seasoned personnel to perform it. So looking forward to that.
Yeah, thanks, David. And Sean, one thing you talked about, I just want to expound on real quick, is that as always on mentality of being in front of targeted key valued customers, not only to make sure that they know you care, but a lot of times it's very difficult to time the need of a particular client with any particular product or service. And so an always on, always in front of them approach in a very targeted manner is really recommended. I always say, like, the contrary to that is, like, a retail investor trying to time the stock market is not a really effective strategy. And from when you engage your customers through marketing and other messaging, if you think you can time the market with, hey, April and May are the best months for an auto loan, I think we have a lot of data points that suggest that that is not true, and your capacity to time that market with your customers' needs is pretty much impossible.
That's a great point. Thank you for sharing that, Aaron. Again, thanks to all of you for joining us today. You reach out to us at info@quikrate.com. We'd love to talk to you, schedule a demo, provide an opportunity assessment, quote a loan review. So thank you all again for joining us today. We'll look forward to seeing you again in 3 months. And again, if anything comes up in between, give us reach out to us. We look forward to speaking with you. Thanks so much and have a great day.
Our Memorial Day as well.
Yes, happy Memorial Day.